Is Sirius XM teetering on the edge of collapse or poised for a remarkable turnaround? With soaring debt, plummeting subscriber revenue, and negative profit margins, the outlook seems grim. Yet surprising metrics indicate potential undervaluation, and strategic moves hint at a comeback. Join us as we dissect the numbers and uncover the truth behind Sirius XM's future. Ready? Let's roll! Incorporated in 2013, Sirius XM Holdings Inc. delivers subscription-based satellite radio services across the U.S., offering a vast array of content from diverse music genres to live sports and exclusive talk shows. By partnering with automakers to integrate their services into vehicles, they tap into the growing connected car market. Their expansion into streaming and location-based services diversifies revenue streams, potentially reducing reliance on traditional satellite radio. SiriusXM's balance sheet, as of September 30th, 2024, highlights significant challenges. With cash holdings of $127 million against a substantial debt of approximately $10.7 billion, the company faces a strained liquidity position. The debt-to-equity ratio is nearly 1, indicating that debt almost equals shareholders' equity, a sign of high leverage. High leverage means relying heavily on borrowed funds, which can be risky if revenues decline. Management is focusing on cautious cash management after separating from Liberty Media to improve financial flexibility. However, the elevated debt levels increase vulnerability to economic downturns, underscoring the need for strategic efforts in debt reduction and operational efficiency. Here's a screenshot of the full balance sheet. Notably, SiriusXM's total assets declined by over $2.5 billion. A drop in equity suggests potential risk. Monitoring asset utilization and equity erosion against competitors is crucial to gauge long-term investment viability. SiriusXM stands out in our proprietary Bose score for exceptional retained earnings and minimal preferred stock, outperforming over 97% of its industry and S&P 500 peers. Conversely, its high debt-to-equity ratio and weak cash position are significant red flags. SiriusXM's third quarter 2024 income statement raises serious concerns. The gross margin is 48.6%, but the operating income margin has plunged to minus 133.63%, meaning operating costs vastly exceed gross profit. Net income margin is also negative at minus 113.13%, indicating overall losses. These challenges stem from a 5% drop in subscriber revenue due to fewer subscribers and aggressive promotions, lowering average revenue per user. Despite these issues, the company is enforcing strict cost controls to stabilize adjusted EBITDA, focusing on long-term growth strategies. Here's a screenshot of the full income statement. Notably, subscriber revenue dropped year over year, impacting total revenue negatively. Operating expenses surged, reflecting inefficiencies that need addressing. These factors highlight the urgency for SiriusXM to reassess cost management strategies to improve profitability. Our proprietary Bose score shows SiriusXM excels in SG&A margin, outperforming 71.8% of industry peers, indicating efficient expense management. However, low EPS growth and profit margins lag behind both the industry and S&P 500, raising concerns about the company's profitability and growth prospects. Revenue has slightly declined to $2.17 billion in the latest quarter, but the real concern is the substantial net loss of $2.46 billion. This significant downturn reflects subscriber attrition due to increased competition, negatively impacting profitability. Operating income at negative $2.9 billion highlights serious operational challenges. On a positive note, management is focusing on boosting advertising revenue through initiatives like podcasting and co-selling. These strategies may help stabilize finances in future quarters. Understanding these trends is essential for evaluating the company's potential risks and opportunities as an investment. SiriusXM's cash flow statement reveals a sharp decline in free cash flow to $31 million in Q3 2024, down 64% from earlier quarters. This was driven by increased capital expenditures, one-time costs, and lower cash receipts due to revenue drop. With a free cash flow yield at 0.41%, the company faces capital strain. The negative capex margin shows investments exceeding cash inflows. Management focuses on boosting free cash flow to fund strategic investments, but current figures suggest challenges to financial flexibility and growth ambitions. Here is a screenshot of the full cash flow statement. Sirius XM's operating cash flow dropped to $1,062 million in 2024, signaling possible liquidity challenges. Investment outflows at $792 million reflect heavy capital spending, which, without offsetting revenue, could strain cash reserves. Our proprietary Bow score indicates Sirius XM underperforms in CapEx margin, suggesting higher capital expenditures than peers. Stock-based compensation is also elevated. However, its free cash flow yield surpasses over half its industry, reflecting strong cash generation despite higher spending. Analyst projections suggest Sirius XM's net income could reach about $1.5 billion by 2028, with earnings per share rising to around $3.85. Despite expected declines in revenue due to subscribers leaving and pricing pressures, increasing advertising revenue from podcasting might help ease these challenges. This situation highlights the need for strategic adjustments to stabilize income in a highly competitive market. Sirius XM's latest earnings call revealed significant strategic moves. The completion of the Liberty Media transaction has made the company fully independent, potentially enhancing operational agility. CEO Jennifer Witz aims to reverse subscriber declines, targeting 50 million subscribers and boosting free cash flow to $1.8 billion. They plan to expand a free ad-supported tier and launch a premium interactive bundle, leveraging Pandora's insights. However, a shortfall in advertising revenue led to a $75 million reduction in revenue guidance, signaling challenges in the competitive ad market. While self-pay net additions improved by 1,400, the reduced revenue outlook highlights potential headwinds that investors should monitor closely. Although Sirius XM's net income surpasses 70% of S&P 500 companies, it only outperforms 40% of its industry peers, highlighting competitive challenges. Its EPS score underperforms both industry peers and the broader index, indicating potential concerns with earnings growth. Comparing key metrics, Sirius XM's price-to-earnings ratio of 16.78 is significantly lower than Disney's 35.24 and Netflix's 39.75. A lower PE ratio can indicate that a stock is undervalued, possibly offering a good entry point for investors. However, Sirius XM's negative price-to-book ratio of -8.23 raises concerns, as a negative PB can suggest underlying financial issues. Paramount's low PB of 0.42 hints at undervaluation. Management believes the market isn't fully recognizing Sirius XM's intrinsic value, highlighting potential risks and opportunities in improving operations and retaining subscribers. Our Bow score indicates Sirius XM's PE ratio outperforms 86.5% of industry peers and 71.6% of the S&P 500, signaling strong earnings relative to price. However, its PB ratio scores 0, highlighting potential concerns regarding the company's book value. According to our DCF valuation, Sirius XM's equity per share could reach $88.14 by 2028, assuming a consistent revenue growth of 3.57%. The 2% long-term growth rate suggests stability amid cautious market sentiments. A WACC of 6.1% indicates the cost of capital tied to the company's current debt and equity mix. Management notes that high leverage is hindering profitability, but expects operational improvements as market conditions stabilize. This implies that reducing leverage could unlock greater profitability in the future. Our proprietary Bow score shows Sirius XM's DCF valuation outperforms 91.5% of industry peers and 97.6% of the S&P 500, indicating significant undervaluation. This strong relative position suggests potential upside, making it an attractive consideration for value investors. The stock's dropped from $58.79 in 2020 to $23.40 in 2024, signals concerns about subscriber retention and revenue stability. While management forecasts a rebound up to $40, significant risks persist. Investors should assess if these targets are attainable amid ongoing market challenges. Our proprietary Bow score shows that Sirius XM's analyst target is stronger than 63.9% of its industry peers and 77.4% of the S&P 500 companies. This suggests optimistic analyst projections, positioning the company favorably in both its industry and the broader market. Sirius XM's substantial debt of $10.7 billion against minimal cash reserves signals a strained financial position, with a debt-to-equity ratio nearing one indicating high leverage. The sharp declines in operating and net income margins, driven by subscriber losses and aggressive promotions, highlight operational challenges. Free cash flow has plummeted by 64%, reflecting liquidity concerns amid heavy capital expenditures. While management strategies aim to boost advertising revenue and expand offerings, the negative price-to-book ratio and recent revenue shortfalls raise red flags. Analyst optimism and a low PE ratio suggest potential undervaluation, but effective debt reduction and strategic realignment are crucial to avert a potential downfall. Make sure to watch another video from our Value Explorer series by clicking the playlist below.